Are you ready to unlock the secrets behind Google's next big move and discover whether Alphabet is about to deliver a surprise in its upcoming earnings? Today on the Investment Diary, we're peeling back the curtain on everything from the AI arms race to ad revenue resilience, cloud growth, to analyst price targets. Whether you're an investor looking for the next edge or simply intrigued by how the world's most powerful tech company balances massive investments with profitability, this deep dive is for you. By the end of this video, you'll know exactly which numbers to watch, what the market expects, and how to position yourself ahead of the July 23rd Q2 report. Welcome back to the Investment Diary. And today we're doing a comprehensive deep dive into Alphabet, Google's parent company. As we head into the July 23 Q2 earnings release, we'll walk through the latest business moves, the ways AI is reshaping Google's ecosystem, what the consensus earnings expectations look like, how analysts are valuing the stock, and what key metrics could make or break the quarter. Let's get started. Let's begin with the big picture. Alphabet's aggressive push into artificial intelligence. Over the past few months, they've made headlines by acquiring Windsurf, an AI startup focused on coding tools, for a staggering $2.4 billion. This isn't just another acquisition. It's a clear signal to enterprise customers that Google Cloud wants to lead the AI coding revolution, directly challenging Microsoft's Copilot and Amazon's Code. At the same time, Alphabet has committed $25 billion to expand its AI infrastructure in the Mid-Atlantic region, coupled with a $3 billion hydroelectric deal to power those data centers sustainably. Think about that for a second. A massive investment not just in computing power, but also in making that power environmentally responsible. All told, they've earmarked roughly $75 billion for AI over the next several years. A truly bold move in an environment where many rivals are trimming tech spending. This aggressive capital expenditure highlights their long-term vision and belief in the transformative power of AI. On the consumer front, Google is beta testing AI mode in search labs. Imagine typing or speaking a complex, conversational question and getting a synthesized, narrative answer complete, with context and recommendations. This isn't just about providing links anymore. It's about a comprehensive, intelligent response. What's particularly interesting for investors is that ads are now woven into those responses, creating a new revenue stream that seamlessly blends search and generative AI. Meanwhile, their duplex voice assistant is making real-world calls on your behalf, booking tables, scheduling appointments, and reporting back via text or email. These innovations demonstrate Google's ambition to turn search and services into an AI-powered experience, but they also raise important questions about how quickly users will adopt them and how seamlessly ads can be integrated without degrading the overall user experience. User adoption will be a key metric to watch for early signs of success. Despite these technological advances, Alphabet isn't immune to macro pressures. Tariffs on hardware components and rising data center costs are squeezing margins. Yet, management is doubling down on AI, betting that long-term gains in cloud and AI monetization will outweigh near-term profit headwinds. It's a classic growth versus profitability trade-off that Alphabet is navigating. Analysts remain broadly bullish, viewing the stock as undervalued relative to its AI and cloud peers, even at today's elevated capital expenditure levels. This suggests that the street sees the substantial AI investments as a necessary foundation for future growth, rather than just a drain on current profits. So, what does the market expect when Alphabet reports after the close on July 23rd? Consensus estimates peg earnings per share in the range of $2.13 to $2.18, robust 12 to 15% year-over-year jump. While we don't have a consolidated revenue figure yet, we'll be laser-focused on several key areas: ad revenue growth, Google Cloud's top line and margins, overall operating margins in the face of heavy AI investment, and any early signs of revenue from those exciting AI mode integrations. These are the numbers that will tell the true story of the quarter. Next, let's talk analyst sentiment and valuation. The street's average price target sits around $203, with a range spanning $185 on the low end to $237 for the bulls. At the current stock price near $185, that midpoint implies about 10% upside. Analysts justify these targets by pointing to sustained accelerating cloud growth and potential new revenue streams from AI-enhanced products. It's clear they believe Alphabet has more room to run, especially as its AI bets begin to pay off. Of course, nothing comes without risks. On the upside, strong ad revenue, resilience, an inflection point in cloud and AI unit sales, and confident guidance from management could send shares noticeably higher. We could see a significant pop if any of these factors exceed expectations. On the downside, slower AI adoption in search, escalating capital expenditures, compressing margins even further, or increased competition from tech giants like OpenAI, Microsoft, or Apple could temper expectations and pressure the stock. It's a competitive landscape, and how Google executes its AI strategy will be crucial. So, Which numbers should you watch when the report drops? Focus on these 5 critical metrics. Actual EPs versus the $2.13, $2.18 consensus range. Did they beat, meet, or miss? This is the headline number. Search ad growth retar ads, still holding up despite new AI features. This will tell us if their core business remains strong. Google, cloud, revenue growth, and margin performing critical for the long haul. Is their cloud business gaining momentum and becoming more profitable? Overall operating margin, how much are infrastructure, investments digging into profits? This reveals the true cost of their AI ambition. Management's free cash flow outlook and H2 guidance, especially around cloud and AI spend. This will give us a glimpse into their future plans and confidence. As for strategy, positive results paired with upbeat guidance could be the catalyst that pushes Alphabet through the psychologically important $200 level. Conversely, if margins contract more than anticipated or cloud traction disappoints, we could see a pullback. To wrap up, Alphabet stands at a crossroads, leading the AI revolution while navigating significant investment costs. The July 23rd earnings release will be our window into how well they balance these forces. I'll be here live after the numbers are out to break it all down and share what it means for investors like you. If you found this analysis valuable, be sure to hit that like button, subscribe, and ring the bell so you don't miss our post-earnings live session. Drop a comment below with your target price for Alphabet heading into the second half of the year. I'd love to hear your take. Thanks for watching the Investment Diary. Until next time, stay curious and stay invested.